Norman Hallett here with your next 4-minute drill for traders. Today, we're going to do something totally different. Now, for the last 108 4-minute drills, we've concentrated on you and your inner thinking, how we can control our thoughts and therefore our discipline and be better traders. Now today, I'd like to touch on how you can take advantage of those traders who are out of control in their trading. Now let's take a look at this simple chart formation. Can you see it? I think you can see it there. It's a candlestick formation called the hammer. Okay, the greatest trading relevance for the hammer is when it appears at the top of a bullish run or at the bottom of a bearish run. Now let's talk about the hammer occurring at the bottom of a bearish run. And let's say I pluck this hammer from a 60-minute bar chart. Now take a close look at the formation and you'll see that I marked off a number 1 point. That's where the market opened during the course of the 60 minutes. And number 2, that's the point that the market closed during the 60-minute period. That square is called the real body. Okay? You have all the price action above and below the real body also. Now, it's all that action below the real body that holds the emotion for the trade. What I mean by that is here is 60 minutes of market action that occurred after a bearish run. You have traders jumping in on the trend, shorting the market, believing that the downward momentum will continue. But what happened here in this 60-minute period? You have the vast majority of people who've initiated short positions. Now they're all now in a losing trade so far. Anyone who is short after the completion of this bar is starting to get a little bit nervous. And all they need is the next bar to open higher, and the weak traders will start to jump ship and cover. Some will hang in there, however, because they're short with the trend. And the trend, of course, is supposed to be their friend. And as the next 60-minute bar moves higher, those who sold during this hammer are getting more and more squeezed as their losses are piling up. Now it's getting very emotional for the out-of-control trader who thought they were doing the right thing riding the downtrend. But here it is, the market's starting to head higher. Here's where a spike higher can take place. And there's where a trader who's taking advantage of the out-of-control trader and bought this market after the hammer formation is looking to take his or her profit during that spike. Why take your profit during the spike when the market looks like it's going to turn around? Well, because you're playing the emotion, not the possible turnaround to an uptrend. By buying after the hammer forms at the bottom of a downtrend, you're banking on the weak traders to start to bail out as their losses pile up, and when the spike happens, you're out. Now, I'm not saying that you can't buy multiple positions after the hammer formation and then, of course, according to your trading plan, and then take profits, say, on half or whatever during the spike and then trail the remaining half with a stop. But for this drill, we're only talking about the part of the trade where we are taking advantage of other traders' emotions. Now, in my opinion, the hammer is one of the most reliable short-term indicators around. Why? It reflects the possible trader emotion if the next bar goes higher. Now, one tip though, because I know some of you are going to be trying to jump into this. If you don't see the market starting to move higher after the first bar, after the spike, and definitely during the second bar after the spike, if the market's not moving higher, get out and don't push it. This formation should elicit that emotional response very quickly. Okay? Would you like to hear more about how you can read other traders' emotions from certain chart patterns? If you found this interesting, leave a comment and let me know, because I've got a few more of these up my sleeve. I trade them all the time. They're very successful. I'd like to share them with you if you'd like to hear. So, until next week and our next 4-minute drill for traders, stay disciplined.